Investors misunderstand the Fed's error. Hi guys, welcome back to my channel. Today, we will talk about how investors are going to lose and how we have to get out of the inflation. So, before we start the video, if you haven't subscribed to my channel yet, please subscribe and press the bell icon. First, we received the Chicago PMI for November. This one wasn't really a beat. However, the index read 46.4 and the service index read 46.2. They were actually somewhat off on that one because they had anticipated 46.3. Again, however, anything below 50 indicates contraction. Therefore, despite what investors might have thought, that was unquestionably a poor economic statistic. The ISM Services Index for November was unexpectedly higher than anticipated, coming in at 56.5 instead of the expected 53.5, which would have been a decrease from the 54.4 from the previous month. As a result, it rose as opposed to falling. Furthermore, it increased and went past the highest limits of the consensus range, which covered the range of 51.5 to 56. Therefore, this was undoubtedly a stronger data point than what the S&P futures fell off fast and never recovered after these statistics were released. That too was a beat and a 12 punch. Gold prices dropped, with a day-to-day loss of around $30. That release was the cause of all the losses, and the notion that the Fed will err by raising rates too much or keeping them too high for too long, resulting in this unneeded recession as a result of failing to recognize that the inflation threat has subsided due to the positive economic statistics. And as a result of that, stocks are suffering for a number of reasons. First, higher rates naturally have a negative influence on stock market values due to their impact on valuations. The discounted present value of future earnings, which is what stocks represent, decreases as interest rates rise. Additionally, if the Fed starts this unneeded recession, profitability will decline. Therefore, when earnings are lower, equities have a lower value. Of course, businesses are heavily indebted. Higher interest rates reduce earnings immediately by increasing the interest expense, which is why the stock market is concerned about all of this. Of course, the truth is that our economy is weak and that we are already in a recession. Never take the figures at face value. Look a little closer to see what's really going on. Because the jobs market is weak if you apply that to the employment statistics, the job market is struggling. Furthermore, the risk that is causing everyone's concern is once again the incorrect risk. Not that the Fed will hike rates excessively, it's that they won't raise them sufficiently. They're going to turn too soon. That's the problem. The Fed won't overstate inflation because it will think the economy is strong when it isn't, and vice versa. The reason why inflation will be higher is that as the economy gets worse, production will fall while money printing increases. In fact, the Fed will change course eventually in reaction to a far weaker economy than it had anticipated. The dollar will definitely crash at that point. And that is where consumer costs will actually increase. The inflation that we are currently experiencing will intensify throughout the upcoming recession. No one can comprehend that. The developed economies have raised borrowing costs by a total of 25.15 percentage points. This cycle as a result of rising inflation, which is the most pronounced increase in decades. Markets still anticipate that the Federal Reserve will increase interest rates by more than 100 basis points, BPS, to 5% by the second quarter of 2019. By mid-2023, the European Central Bank is anticipated to nearly double its deposit rate to just under 3%, after raising rates by 200 basis points since July. The possibility of over-tightening exacerbating a downturn is on investors' watch list for the upcoming year, due to the anticipated topping off and the impending recession. Everyone automatically expects that if the economy deteriorates, inflation will increase because inflation is the result of the expansion of the money supply. Additionally, the Fed will increase the money supply in an effort to stimulate the economy as it becomes weaker. Additionally, as a result of the massive flight from the US dollar by foreign central banks and individual investors brought on by the reintroduction of quantitative easing, consumer prices will rise sharply. Increasing our current account and trade deficits will also result in an upward spiral of inflation and economic decline. Returning to the stock market, however, the Dow has lost around 830 points in the past 2 days as a result of the stronger than expected data that was released on Monday, a 2.4% decrease in value. It has decreased 2.9% so far this week, and 2.9% for the entire month of December, which still has 2 days left. S&P 500 performance is even worse. It has decreased by 3.2% during the past 2 days, bringing its 4-day December decline to 3.4%. The S&P has fallen for a 4th day in a row. So far this month, it has been down on every day trade. Even worse, the Nasdaq is down 3.7% this week and 4% this month. The Cathie Wood ARK Innovation Fund, one of the Nasdaq's most erratic names, is down 9.3% only this week. The biggest one is Tesla, which is down 7.7% for the week. Currently, gold stocks are also declining. Stocks of gold are down 3.6%. So far this week, cent. However, they scarcely decreased for the final 4 days of the month. Less than 1% of the gold price is down, while silver is down approximately 4% during the past few days. However, silver is essentially flat for the month. Thus, it has kept the majority of its gains. In fact, since Powell's speech last week, the stock market has lost all of its gains. Where this hawkish remarks caused the markets to rise, the gold stocks meanwhile have not. In actuality, the price of gold equities has increased by around 6% since that speech. The gold stockpiles are still very strong. Therefore, despite the significant decline over the past 2 days, I anticipate that trend to continue. Remember that the main distinction between a gold stock rally and a conventional stock rally is that the gold stock rally is genuine if we see a year-end surge in gold stocks. It's a bull market right now. It's not a head fake either. It is not a weak-kneed protest. This is not a quick cover. This is the market entry of fresh longs. This enormous bull market is still in its early stages. See, gold is also seeing a fresh bull market at the same time. A fresh bear market for the US currency has begun. In fact, on Sunday evening before the US market opened, the dollar reached fresh lows and gold reached new highs. By the way, considering that Bitcoin has been trading at roughly 1,700, many people are talking about constructing a floor around that price. And even if the Nasdaq has fallen significantly over the past few days, Bitcoin has been trading more sideways, which has led many people to exclaim, "Ah, we found support." Recall that this is a bottom and that Bitcoin has been declining in this manner for much the whole bear market ever since it was slightly under 70,000. After making a downward move, Bitcoin consolidates its losses before making another downward move. People claim that the market is constructing a bottom line each time it consolidates its losses, but in reality, the market is merely creating a trapdoor through which the market will tumble. Every time Bitcoin stops tumbling down the staircase, it is merely resting on a landing and getting ready for the next leg down, which is about to happen. It's noteworthy that Bitcoin hasn't actually seen a significant one-day meltdown. There have been numerous big collisions in the past. On the ascent, most of these severe collisions took place, and while the falls jarred individuals, they also gave them a chance to buy ahead of the next climb to new highs. But throughout this down market, we haven't seen any of those significant, terrifying falls. Why? Because bear markets prefer not to upend anyone. They wish to confine everyone within. They aim to spread a lot of unfounded optimism among individuals that the bear market is ended. If there were additional spectacular one-day crashes, keep in mind that bear markets move down a slope of optimism, and the hope can be disappointed. Because silver is even better positioned than gold to produce spectacular returns as the world population exits not only fiat currencies, but also fiat cryptocurrencies, including one of the worst performing stocks on the day, Meta, formerly Facebook, which dropped 6.8% today and is now down 7.6% over the past 2 days. Bitcoiners should buy silver instead of Bitcoin if they want a supercharged version of gold. The EU is considering taking some action to limit Meta's capacity to collect information from its users, and then make it available to marketers in order to provide better targeted ads to its advertisers, which helps justify the expanse. This news sends metal shares plummeting. Additionally, since they are not need to pay to display their advertisements to individuals who are most likely to have little to no interest in their items, a greater number of businesses are able to advertise their goods. What harm can Facebook users incur by giving their advertisers information about them? The worst case scenario is that the Facebook user discovers products or services that they may truly be interested in, and may actually want to purchase after seeing advertisements that are more relevant to their lives. In other terms, marketing may be considered a service. Due to the fact that Facebook is free to use, advertisers will be seen by everyone who visits the site, making them more of a nuisance than a part of the content. In order to offer its users a free service, Facebook must generate revenue. So, where does it obtain its funding? They are advertisers. Therefore, if you use Facebook, you will see advertisements. The true benefit here for Facebook is that many businesses can only afford to advertise due to the targeted nature of their advertisements, as they aren't spending money to reach a demographic that won't be interested in their goods. Every time someone is advertising, they want to tailor their messages to the target market. Thank you for watching this video. If you like this video, please hit the like button.